Good morning, good afternoon, and good evening, Alan. It's Friday the 18th. Let's do our Friday investment talk. There's a lot that happened this week. I think you want to talk a little bit about allocations in pensions, right, Alan?
Yeah, I just find this pretty fascinating. It was from a BCA research note. Two things that kind of struck me. One is that US corporate pension plans are still factoring in a 7% per annum growth. I think everyone would find that pretty staggering. That's a very high rate of return for something that should be relatively conservative. And it's exacerbated by the fact, and as it states there, that you're only over 50% in bonds. You can see the lines from 2005, so we're looking at 15, 16 years, the lines in green are steadily decreasing, and the middle lines, which are in kind of beige color, are steadily increasing. And that's basically equities being reduced and bonds being increased. And I just find it very difficult to understand, given where we are in the cycle with inflation, with interest rates being incredibly low, how that really can play out in a good way. If we move to the next slide, what we can see is our good old efficient market frontier curve. Just to maybe take through people that don't know what it is, it's basically you can add risk assets, volatile assets to a portfolio to actually overall reduce the risk and overall reduce the volatility of that portfolio. That's a Markovitz Nobel economic winning argument of a number of years ago. But basically, what's interesting there is you look at the outliers. What's interesting, the bottom index is volatility, and your left index is portfolio return. And so you've got things like US small cap are going to do well, emerging market equities are going to do well. Maybe US high yield is kind of in there, but most of the bond markets are not really likely to return 7% unless you have a much higher rate of equity in that. And I think what we are doing and we are seeing is that to get those returns over a long period of time, you've got to look at US small cap, you've got to look at global small cap. Actually, you've got to look at emerging market equities. So it's really pushing the risk tolerance out, and having to accept volatility because of that.
I think it's interesting to hear that they have this assumed returns is this black line down here where everything's kind of muted, right? Assumed returns for US small cap are way down here, where in the past 10 years they've been producing returns way up here. So maybe there's just a dampening in the whole return environment because of where we are with interest rates. Maybe we'll get onto that.
Absolutely, which makes 7% returns, expected returns on corporate pensions, even more baffling, in my opinion.
Yeah, you'd have to be really careful about where we're going to get that real growth. If you've got inflation at above 5% annually now, we have expected quarter two GDP to come in at around 6%. You only have 1% real growth in the economy. So this is the issue that the Fed is facing right now. We'll get into that in a second, though, I think, if we have some time. Ron, you wanted to talk a little bit about some stocks that may be undervalued in this market. I think you want to talk about some healthcare stuff.
Yes, I've been talking about healthcare stocks for several months already, and there is a YouTube video that explains what to buy in healthcare and ETFs in healthcare. Last week, I discussed Biogen stocks that went up almost 40% because of the new approved drug. But now the Biogen's move opens the possibility of approvals for other drugs that like Aduhelm slow the cognitive decline, and these drug companies are like Eli Lilly, Eisai, Roche. So overall, pharmaceuticals are going up about 10-15% year to date, but there are stocks that are still undervalued. You see them on the list, and they are Vertex, Hologic, Organon, Insight, and Cigna, and they are down about 20% this year, like for example, like Vertex, and 32% over the past 12 months. And Vertex just had few failures of of their two drugs that sent their share prices down to 21% in a single day in last October, and then again 11% on the second failed trial recently. But analysts still think this is a very great stock. The fundamentals is great. It has cystic fibrosis franchise and it's undervalued. So currently it's a good stock to go in. So the next one on the list is Hologic. It's the medical technology company that's specializing in women's health and diagnostic tools. And the stock is down 15% this year so far. And again, great fundamentals for the stock to be down that much. The Organon Stock, Organon company, is one of the newest members of the S&P 500. It's a spin-off of Merck. This company, Organon, focuses again also on women's health, but also sells off patent drugs, biosimilars, and other products. So if you can see, yeah, it's absolutely new company.
Yeah,
absolutely, yeah, new company. It's literally spun off Merck early this month. So, but great analysts really think high of this stock, so they think it's a buy. Also on the list is Incyte, INCY, and the mean target price is 106, which is already 27% above its recent price, and that's what Citibank analysts predict. And the stock is down 4% so far this year, but mostly investors been scared off by impending expirations of patents protections on a blockbuster drug. But overall, again, the analysts are confident on its prospect, and that's part of S&P 500. Then on the same list of undervalued stocks, there is Cigna. It's the major health insurer, and the recent price is $239 or $240 on this. If we see, it's what, $232 now? And the target price by most analysts is $295. Cigna shares are up 15% this year, but analysts say there is tons more room to grow. So I will also would like to look on the other company that it's in healthcare. It's a healthcare insurer, but for cats and dogs and other animals and pets. So we've been talking about it for a long time. It's Trupanion, and you can see it's also performing quite well, but still plenty of room to grow. And we've been covering it since last year, I think.
Right. I think, yeah, a lot of these charts need to come down a bit more, Cigna for sure. But the one that did look interesting on was Insight, I think, right? Yeah, a lot of support here in this level, and kind of nice base here. The last 2 quarters they beat strongly on their earnings. That looks interesting. Of course, Trupanion's on a roll here on a monthly chart. We've talked about that. Really jumping here. But this is come off a base here since the beginning of the year. And
yeah. I was trying to work out when it came back down, and it started to bounce back.
Yeah, this is one of these that sold off hard.
Yeah.
In February.
But looks to be.
Yeah, this is kind of a good.
It's over that hump now. So it seems to be going.
So yeah, this looks great. It's having a great day today. Let's talk a little bit about the market. I don't know how much detail I can get into. We can do an English webinar later next week about some of the situation that happened this week, because the Dow actually put in its worst week since last October. You can see that. This was the worst week since last October. A really bad day. Well, it all started, I guess, when the Fed Reserve started talking Wednesday in the United States, and then it had a bad day yesterday, and then again today, this morning, it just kind of fell again. So one of the big problems we see is the stocks that have been hit hard are things that are value stocks. So if you look at yesterday on the value stocks, it was down almost 4%. Today it's down another 2%. And this is where our strategies are allocated, because these had to perform so well for so long. So we're going to probably see a change in the strategy for July. Likely the strategy will switch to the Qs, because the Qs are holding up.
So is that necessarily like a risk on from a risk off?
The issue has become that a lot of these value stocks have high multiples, and I think we can cover that Wednesday, is how the Fed changed their wording and really a more aggressive stance on interest rates. Interest rates didn't go up. It was normal day in terms of what interest rates, but there was a lot of talk and a big change in what the Federal Reserve came out with. And there were some revisions to near-term economic forecasts, where the Fed now sees 7% growth this year in GDP, but there's also higher inflation. And that inflation has kind of put some of the Fed officials on scare and on watch for an increase in interest rates, again, sooner than expected. So originally the expectation was interest rates would start increasing in 2023, but now there's at least 7 participants who see one interest rate hike as appropriate by the end of 2022. And that was up from 4 previously. So almost half of the 18 FOMC participants now think that there's going to be an interest rate hike in 2022. There's even an equal number of participants calling for 2, 3, and 4 hikes by the end of 2023. So this has really changed a lot. They're seeing inflation. They're seeing inflation in all aspects of the economy, a lot on car prices, a lot in housing. It was kind of interesting. A hedge fund manager we followed out of New York, this hedge fund manager came out with reasons that the Fed should get in front of the increase in inflation and come up with a thinking about raising interest rates. In the last policy meeting, that wasn't the case. But this June meeting, Powell actually used the words, we're talking about interest rate increases now. And that means as soon as possibly even July, there'll be a further change. And then even people are calling for maybe a big change come September. So that is what this hedge fund manager said he would be doing if he were sitting in the Fed. And now the Fed's kind of following through and saying, yes, we're going to talking about interest rate increases. And those that's enough to spook the market. And that's basically the point here, is that scared the crap out of everybody, especially these value plays. You see, we talked about Honeywell. The Honeywell chart's a disaster. Last 5 days, 6 days, just crushed here. A lot of stocks, AT&T, breaking down past where it is here and going to all-time lows for the year. Any value stock is just it's just forming a top here, or at least.
So these are not times to buy.
No, this is scary times. I mean, look at RPV's chart. This is really not a good time to be sitting here thinking, oh, this is going to be wonderful. We need to see some kind of bottom, forming, and Wednesday, by next week, it'll be more clear. But there's a big divergence here between what the S&P is doing, especially the Dow, and the and the Nasdaq 100. The Nasdaq 100 was up. We highlighted that in our Telegram channel. They closed at a new all-time high yesterday, whereas the Dow Jones, on the other hand, has fallen 1,200 points since making its last intraday high in early May. It even touched its lower Bollinger Band. Big divergence in the market. I don't think the overall indexes show the kind of damage that's been done in some of these stocks, and we can look at say XME, which is the metals ETF, really losing in the last 3 days, it's lost. It's when 47 is down to 41 today. So there's got to be some settling in the market, and I don't see there's any really reason for it to settle if we're going to be talking about higher interest rates in the coming months. So this was a big shock. There's a lot of data out there about how this changes the narrative for the S&P. The hedge fund manager that we follow thinks there's a correction of 20 to 30% coming in the next 6 to 9 months. There's a lot of indicators that show the market has been overbought for a long time. We've mentioned that before. We need to see the Fed comes out and maybe clarifies some of this next week in maybe some talk among some of the Fed members, not just Powell himself. But the problem with that is a lot of these Fed members are now much more hawkish than Powell himself. So it's quite interesting if Powell will be able to hold the camp down that, hey, we're not going to increase interest rates anytime soon, and get some of this rhetoric back on the table. I think that the issue is there's a lot of changes happening. This is rough times in the market. June, July, August, September are not good times to be involved in the market. And I think even though some of these main indexes are showing that they're holding up, like the NASDAQ, this thing can all change pretty fast. So we'll see how it goes, but I want to kind of go into more depth on this next week and probably talk about how things are panning out in the middle of the week. As we head towards the end of the month, we'll probably get a change in the strategies and some of the other indicators we look at. So thanks for tuning in. We'll talk next week then. Thanks. Bye-bye.